Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in and take a look, see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com. I dive deeper into all this stuff, looking for potential investment opportunities, sharing those opportunities with everyone in the community. We do have a special going on. Special is the coupon code, 50% off the first month only, and a larger discount on the yearly membership. We have a question and answer session coming up at 5 p.m. Sunday, Mountain Time. You guys can ask me whatever you want. There's a couple of questions that people have sent in. There is some information I'd like to share with everybody in the community, and we'll get into it on Sunday. Patrick Karam says, as much as you might want the gold to silver ratio to break down, instead it did the opposite. It broke out. This is still a risk off warning sign. Gold is vulnerable. Silver is vulnerable. Stock markets are vulnerable. So what does he mean by that? Well, when gold outperforms silver, it means that it tells us about a certain market condition and that we have recently broken this ratio to the upside. The way that I view it might be a little bit different than maybe some other people, but I will share my opinions about this. You can see on the bottom here, the stock market is breaking down, and that has been heading lower here the past few months. So you can see gold breaking higher and the S&P 500 breaking down. So some people will say, oh, it's a breakout. We need to get ready for it. What I would say, and what could be a possibility, and again, I don't know everything, but when you get these spikes in the ratio like this, those have generally been really good times to buy silver, to do the exact opposite. So rather than getting afraid, it is better better in my opinion, to look for potential entry points. And the reason I say that is, I mean, how often has the gold to silver ratio been at these levels? It's been hardly anything. And if you were to do a normal distribution curve where it comes up and the majority, I can't draw this very well. So you've got a little bit. So let's say your flat lines there. So nothing's really here. You start to come up and then you go up and then you go down like that. So the majority of time it spends, between here, a lot of the time it's trading in that zone. But if you're able to get on these corners here and then you're patient, you buy silver and then you swap it back into gold somewhere down here, perhaps. Or if you get a ratio like 1980, you would have been far better off buying gold than silver because silver crashed as gold maintained purchasing power a lot better. So I look at things from that perspective, just a bell curve. And if you're this far cheap for silver, I would be loading up on silver. We've seen gold rip to the upside. It's basically a moonshot. And in all honesty, guys, I do not start buying stuff when it goes vertical like this. I usually I don't look at stuff like that. But if I get an opportunity where silver is like here, if you look at silver, it's in the same situation. There's your kind of breakout. It's breaking higher, and it's earlier in the move. Also, you've got this 45-year cup and handle pattern. I like viewing it in the line chart. It's easier to see. And we haven't broken out of that yet. So my view, take it for what it is, I would much rather own silver here because it hasn't had the big run up as recently as gold. And I think that with the ratio where it's located, I think it's far cheaper to go into silver. So my bet would be going into silver. Now, a lot of people are going to say it's a risk-off environment, but that's the entire reason you're getting the deal. You're getting the deal because all of the chart readers are acting like this. So we can steal silver at this ridiculous price because everyone's afraid. And that's where the sentiment works in your favor. You need to buy when everyone else is fearful. It's not, it broke out. So the question would be, how long do you think we're going to stay here? And even if you stay there long, long being like 6 months, that's all an accumulation period. So you're buying it at a historic low, and to not pull the trigger at a historic low, I think, is something that I'm going to be pulling the trigger at historic lows. Just put it that way. I would be pulling the trigger. Kevin Vanborough says, predictable. How soon until Trump begins calling for quantitative easing to lower yields and expunge the federal debt? Guaranteed, he will choose to print the debts away. Foreign holders of U.S. treasuries will receive printed money, not taxed. The real inflation wave is ahead. And that's where the commodity bull market comes from. It's the devaluation of the dollar. So it's not like a barrel of oil becomes more valuable of being a barrel of oil. The pricing of commodities go up and down based off the value of the underlying currency. So here's Donald Trump. He says the ECB is expected to cut interest rates for the seventh time, and yet, too late. Jerome Powell of the Fed, who's always too late and wrong, yesterday issued a report which was another and typical complete mess. Oil prices are down, blah, 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 blah. That guy sounds like a little sixth grader. it's sixth grader talk there. He's trying to belittle Jerome Powell, and I don't think he can do anything about it. I don't know if Powell, I don't think he can get rid of him. I don't know. But that's that. Why don't you just go talk to Jerome? Why are you tweeting this? I don't understand. This is like sixth grader language here. But yes, he's going to print a bunch of money. He wants lower yields. Lower yields is going to get you a lower value of the dollar, and the lower value of the dollar is going to get you massive inflation. What a great plan. What a great plan. Yeah. Joseph Brown says debate about Trump being able to fire Powell or not misses the point. The problem is not about who holds the power of central banking. The problem is that the power of central banking should not exist in the first place. That's the first thing that I've read all day that makes any sort of sense. The power needs to be stripped from central banking, period. I know these guys are talking at each other. It's probably just some sort of dog and pony show going on here, where eventually they're going to cut rates. Eventually they're going to weaken the dollar. And we're back at square one with Federal Reserve being the root of the problem. If the root of the problem is still in existence, then your problem still exists. Doesn't matter who runs it. Totally agree. Joseph Brown is 100% right. Captain Foresight says, Disty is tracking perfectly the bottom of the 5-year cloud. Disty print, so it's U.S. distillate stocks, is highly supportive to crack spreads. So basically, we don't have any inventory of it. Inventory is running low. You can get great crack spreads or refining spreads. And that is where we're currently at. We're at a very low inventory level. And that seems to be the trend of everything. Oil's at low inventories. I don't know what gasoline's at. I haven't looked at that in a while. Distillate's at low inventory. Everything's at low inventory. The Strategic Petroleum Reserve's at low inventory. Lots of stuff is. Retail bag holders. So leveraged long ETFs saw a weekly inflow of 6.6 billion last week, the most in history. So record influx comes amid historic tariff-driven market volatility. So a bunch of money coming in. They are buying leveraged long ETF weekly flows. Now, is that the smart thing to do? I don't know. I think all leveraged ETFs are the wrong thing to do. Because over time, they asymptotically, which means they approach a certain level. They don't quite get to that level, but it approaches that level over time, and that is zero for these leveraged ETFs because the way that they gain the leverage has some sort of permanent decline. What is that called? It's not deterioration. It asymptotically declines to some level of zero. You know, it approaches zero but never gets there. I can't remember what it's called, but it's a deterioration. I'm using the wrong word. I want a different word. but I can't think of that different word right now. Coming down, we've got part-time trader, beauty of a chart. Commodities will provide shelter throughout the storm. This is Casper doing the Huey versus the S&P 500 and the breakout there. It's not really a storm. It's more of a rotation. We've gone through many years where commodities have underperformed and financial assets have outperformed. We bottomed in 2020, and so did interest rates, so did a whole bunch of different charts, so did a lot of Elliott wave analysis. There's a lot of stuff that basically paints a picture that we are turning into a tangible or hard asset commodity bull market, which started in 2020. So we are in a super cycle, and people don't realize that. What they want is they want the prices to go vertical, and then they're going to say, "Oh, you're wrong if you get a pullback." They don't know what they're talking about, in my opinion. They don't know Elliott wave analysis. They don't know that things don't go straight up. They're basically see ball, hit ball, and that's it. There's no deeper thinking. They play checkers at best, not chess. And maybe they're not very patient. Tough to say. But the commodity bull market, we're in it, and it's going, and we're about to enter the third wave at some point here. That third wave is going to be massive, and in my opinion, if you're not positioned in it, you're going to get absolutely smoked because the dollar is going to get smoked, and on top of it, I bet you the stock market and NASDAQ and the intangible assets, probably crypto, gets smoked to the downside. So all those will basically have money outflows while commodities and precious metals have money inflows. Natural resource assets have never been more undervalued in my view, and this is one of the reasons why I think we're going to see a big move in commodities. Most commodity prices are trading near historical lows when measured against gold. We're at the early stages of recognizing that the monetary issues we face can't be resolved unless nations begin to meaningfully accumulate gold. I don't know if that doesn't mean it gets resolved. They are meaningfully accumulating gold because there are problems in the bond market and in currencies. There's nowhere else to go. It says the next phase comes when policymakers are compelled to slash interest rates at any cost in order to manage their growing debt burden, and that's going to kill the dollar. That could mean firing Fed officials, introducing new frameworks to force rates lower, pressuring banks to absorb more treasuries, or agreeing on deals with foreign central banks to buy U.S. debt. There's virtually no limit to how extreme these policies could become. The key point, however, is that once rates are artificially suppressed, it is highly unlikely that gold alone will benefit, as we are currently experiencing. This phase of the cycle is likely to ignite a broader rally across the commodity space. And we're getting closer to that point in my view, and we are getting really close, I think. Gold's gone vertical. Gold's our leader. I think inflation's coming, and that's what I mean by our leader. It's leading inflation. Inflation's going to come through the system, and it's going to rip commodities to the upside. It's going to take time. You just sit there and wait. So that's what we're seeing there. LNG Canada's 40 billion plant is but weeks away from shipping its first export cargo. So that's LNG coming to Canada. And this next 40 billion plant that's coming is just weeks away from completion. The big BC LNG, what they call it. Here's another one from Kevin Bambro. Let's read this guy. So he says, the only way to fix a broken system is to break its rules. Example, pushing for the financial system to adopt crypto coins with no intrinsic value won't fix the system. It will just further shrink the number of people that profits from an artificial money creation system. Fundamentally, money should only be earned by providing goods and services to the economy. Money is a form of social credits, and savings should be obtained providing more for others than you take. Profits on money should result from wisely allocating your savings capital into ventures that create more value than they destroy, resulting in a margin. Stores of value are assets that have intrinsic value based on their enduring uses and the energy required to obtain them. That sounds perfect. That's like music to my ears. I think we should get to a system that's like that. I crypto. I'm not a big fan of crypto. Everybody knows that. So I don't want to go too deep into that. What if the liquidity in question this time is physical gold liquidity? And the collateral in question this time is physical gold as an international neutral asset collateral. Wouldn't that flip the script? I think that's where we're going. In fact, the chart suggests that's where we're going. Oh, yeah, I agree with that. So this is me sharing that gold to silver ratio chart on here. And I'm going to talk about Jeffrey Snyder here. He says, the signal that predicted 2008 and 2020 just flashed again. There's a powerful indicator that very few people watch, but every time it spikes, something major breaks in the financial system. It just hit extreme levels again. I'm talking about the gold to silver ratio, a key signal of monetary stress, and it's not alone. The copper to gold ratio has plunged. Interest rate swap spreads are near record lows. Global liquidations are quietly accelerating. The last two times these signals aligned like this were October 2008 and March 2020, but that's when the crash already occurred. It already occurred. So this spike here in the gold to silver ratio, did the crash already occur? Or is it still coming? So, I mean, that's really the question. Has it already occurred or is it still coming? If it didn't come already, then how did we get to 100 to 1 ratio? 100 to 1 ratio? Huh. Most investors are buying at the top. Record gold inflows for GLD coming in here. And again, when things go vertical, I don't really go into them. I just wait. So gold could continue higher. I wouldn't sell gold if I owned it. I mean, maybe swap it into something else if you think something's cheaper, like silver or platinum or something. But I wouldn't get out of the trade. I wouldn't go back to, if I own physical gold, I wouldn't go back into paper dollars. I would swap to maybe something else, but to me, there's nothing to worry about in gold. I think you're sitting pretty. So even if we go and we get a pullback or we get a consolidation, it wouldn't bother me. I don't really care. I don't see any other alternatives that are that much better outside of precious metals like silver or platinum if I wanted to stay out of the system. There's no other option. Crude oil looks dead to most people, but commercials, the pros who live in this market, are quietly buying. They don't trade headlines, they trade value. With positioning shifting and price holding key support, a bounce towards 75 and 80 isn't crazy. Watch this space. So this is crude oil, highest level of smart money buying since 2020. Here we are coming on up. And I would agree. I'm a buyer in crude oil. I think it looks fantastic. Totally agree. Another one from Kevin. He says, losing the reserve currency status is unthinkable to most people, especially in the United States. Well, I say you best get thinking long and hard about it. Imagine what life would be like when you run a 2 trillion annual deficit and your dollar craps the bed. Imagine what will happen when the trade deficit is actually forced closed. Not necessarily because you choose to buy less, but because the price of foreign goods goes up so much, you can't afford to buy as much stuff. Plus, also the price of domestic goods goes up because foreigners are buying to balancing trade. What will the buy? Agricultural commodities, energy, etc. Stuff that hits core CPI. That inflationary crunch will then reduce the demand for foreign manufactured goods because disposable income drops. Actually, having to work to get stuff is a shockingly different existence than being able to enjoy 500 billion to nearly 1 trillion more goods than what you produce every year for over the past 20 years. It's huge. When you look at the total volume of goods that the deficit represents, is unbelievable what's been given to America in exchange for money rolling off a printing press. Who's been ripping off who? Well, when the reserve currency status is gone, and it will be going, there will be a shocking realization that America got a massive subsidy from the rest of the world, not this BS narrative being perpetrated these days. The only people scamming the American people are the top 1% of American people figured out how to avoid taxes and profit excessively from outsourcing America's manufacturing bases to the detriment of their own people. There's a reason why these banks and big business leaders and even Trump donated to both political parties, because they liked the gridlock. They liked the system. It made them very rich, and they want the American people to be focused on blaming others instead of asking for a redistribution of wealth within their own country. Here is global stock outperformance. Looks like a structural shift that has long legs, and we are starting to get a double bottom in the MSCI All World excluding US versus the Equal 8 SPX. There's that ratio turning higher and putting in a double bottom. We are at the beginning of the beginning here, guys. Beginning of the beginning, and it's going to get real fun for those that are long non-US equities. High Heat says a new bull market in oil has begun. I agree, it has begun. The Crude chronicles every single populist in American history has either abolished or subjugated the central bank of their time every single time. Look at this, guys. This here is all commodities in the dark blue. In the green, this is your world M2 expressed in the United States dollar. Every time that goes up, the M2 money supply, it puts commodities into a shortage and the price of commodities goes up. Or conversely, you could say that the value of the dollar goes down and commodities are priced in the value of dollars. And here we are, and he's got a potential turning higher where populism returns. The energy transition, China versus US, Russia versus NATO, Middle East wars is coming out in the future here. And we've got a potential move higher and a double bottom here if you look across. So if we see the M2 money supply, which it is going up, we're probably going to see all commodities go up. That's what follows. And you can see the lag that we get behind this as the price goes up. As M2 money supply goes up, the price of commodities goes up. And that's all I've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special that coupon code. Don't forget, we've got a 5 p.m. Mountain Time question and answer session on Sunday. All right, guys. We'll catch you later. This is Finding Value.